Hi there, my name is Kent Skornia, President and CEO of Krilogy, and I'm with my partner, John McArthur, Chief Investment Officer here at Krilogy. John, how you doing?
I'm doing great.
Here we are another month. This is our September market update, and what a journey we've had so far this year. The first quarter kind of really difficult. June was our bottom, so to speak.
Right, yeah.
We bounced back, almost a 9% upswing in July, and then we sort of leaked out a little bit more, and then a pretty good rip on Tuesday because of a tough CPI score. So, what's your thoughts?
Yeah, it's been quite a ride. Seasonally, we're in a tough period here in September and into October from a historical perspective. The market's digested a lot. I could show a chart of the 2-year Treasury, and it would look like a tech stock from the 90s. In the last year, it's gone from under 50 basis points to 3.85% today. So the market, relatively speaking, has done a pretty good job of digesting significantly higher rates in a short period of time. When we reflect on earnings season, it was much better than feared. We're seeing a slowdown without question in economic data. But there's also a lot of pessimism. There's a lot of negative sentiment. There's a lot of pessimism.
When interest rates rise that much, right? Yeah. That quick. I mean, we haven't really seen that since Volcker, right?
Right. Yeah. Right.
And that's 30, 40 plus years ago. Right. You're bound to get some economic data that's going to be a little bit off.
Right. Yeah. To be expected. The Fed really doesn't want to have a recurrence of what happened in the 70s, which is this inflationary spike kind of going through fits and starts.
Yep.
Finally, Fed Chairman Powell very recently spoke tough on monetary policy. I think prior to that, he kind of gave some nuggets of hope and optimism for the market. And so the market had anticipated the end of the hiking cycle sooner than what's realistic, because inflation, while likely to still roll over pretty hard, really just hasn't shown up yet in the headline numbers. There's a lag effect there. I suspect at next Fed meeting in November, we'll start to see that, which should be a relief.
You mentioned earnings, right? The stock market is a reflection of earnings more than anything over the long period of time. Q2 seemed okay, right? Held up okay?
Sure did, yeah. Sure did.
What's your thoughts going forward?
Well, when we started the year, the S&P 500 was projected to have about $250 in earnings for 2023. That's come down, but not all that significantly. About 240 is where the estimates stand now. It's reasonable to expect that to continue to decline. The backdrop that we're in is tough, because with rates and inflation higher, it's unreasonable to expect multiple expansion in this environment, and earnings are not accelerating. They're either decelerating or stabilizing in more of a best case scenario for the moment. But if earnings come down further, we could start to put realistic multiples and price over those earnings for next year, and still be complacent with a level that's around where we are, higher, lower. It's not outrageous to think that at 3,900, 4,000 on the S&P that we're expensive at the moment.
What you and I actually have a lot of conversations with our wealth advisors who are helping our clients with current cash situations.
Right.
A lot of companies have actually been sold over the last few years. What are clients saying to you, and what are you telling our clients in terms of what to do with the cash?
Well, it's important to have a disciplined portfolio construction process on the front end. Investors have gotten used to the negative correlation out of fixed income and equities. Of course, we haven't seen that this year at all. As bonds have fallen double digits, and obviously stocks are down 18, 19% at the moment. But we expect that to return. Our 40-year fixed income market veteran, Paul Gabriel, is really pounding the table at, when the 10 years at 3.5 to 3.75, if we get there. He thinks that represents a
huge opportunity,
a good opportunity on a go-forward basis for fixed income. So now is certainly not the time to panic on fixed income. But to your question on on what to do with cash. It starts with portfolio construction. Generally speaking, it's not an environment, given what we just mentioned on multiple compression and some level of earnings deceleration, but having process around deploying that cash can be advantageous. And our new director of technical research, Jamie Setley, is helpful in that regard, because he can at least provide some perspective on the short and intermediate term from a technical analysis lens, which isn't predictive, but can influence decision making around probabilities.
Yeah, and that's really powerful for someone really reallocating from owning a business to now having cash. And now you have to build out this portfolio. I was speaking to a client the other day. It's similar to building a house. Yeah. You got to put the foundation in first. Right. Then you build, everything else from there. Right. And the foundation of a great portfolio starts with the fundamentals, which your team does such a great job on. The R word, recession. Recession. Yeah. Some say we're there. Some say we're going there. Some say we're not going to go there at all, and the Fed's going to wiggle through this thing. What's your thoughts?
Historically, the Fed in past cycles, the Fed has gotten Fed funds rate above CPI, and for reference, CPI is still around low eights, and Fed funds is 2.5. They'll likely hike 75 basis points next week, would be my expectation, but from that lens, we have a way to go, which would suggest that something will break in the economy. Now, I think the reality is that the market has gotten accustomed to this really transparent Fed. It certainly wasn't that way in the Greenspan days. And I think Fed Chairman Powell realizes that the tough talk from a policy perspective, as we started talking about early this year, has to persist. Because without it, we get easy financial conditions, and that's exactly the opposite of what they need right now. So, the tough stance in part can help do the trick in helping supply and demand equate better, and that's part of their objective. But regarding recession, it looks more probable as days go by, frankly, for some time in 2023. I think from an investor perspective, it's nothing to get too fixated on. Yeah. I mean, the market historically bottoms well in advance of the deterioration of the data. The average recession of the past 12, the market's declined 30%. Could be less, could be more. We've already seen 25% if we look at the June lows. Right. Not suggesting we couldn't work lower from here, but I think the market has digested a lot. I think if we get any meaningful meltdown in some of the inflationary pressures, which I expect we will increasingly see as the Fed rate hikes take hold, I think those are all positive catalysts, not to mention seasonality. Midterm election years going into Q4 has historically been a great time for the market. You can't take action, of course, based on that historical fact, but that married with some really negative sentiment, I think can align actually quite well.
When someone says to me, the recession is coming, I revert back to the conversations I have with our business owner clients. Last night I was with several of them, and their businesses are booming. Their biggest challenge is actually, how do I find humans to fill the need, to fix, to do the job. Right. And if they could find more people, they could do more work, and the companies would continue to really grow. And they're growing at high rates.
Right. I think there's really key points there. I think that's why, recession probabilities for 23 have increased, is that the Fed recognizes that there's a really close tie between services, CPI, from an inflation measure perspective, and wages, and we're seeing a really continued sharp rise in wages, and so the only way to really solve for that is higher unemployment, which would mean true demand destruction, and it just doesn't necessarily mean much further doom and gloom for the market. I think to your point in your conversations with some of our clients is that profits and profit margins are at record highs.
Right.
For this second quarter, record highs. And we just saw retail sales On the consumer side of things this morning, better than expected. So, it's an interesting period coming out of what we've been through the last few years with COVID. It's making this time a little bit different in some ways, or a lot different in some ways. We've got really healthy consumers, generally speaking, and from a financial perspective, and the same with corporations, which could theoretically help mitigate some of that.
And it could take time for those interest rates to come through the economy, where the consumer starts to feel the interest rates. I mean, if you're going to go out and buy a car, 2 years ago you get 0% financing, you don't even think about the interest rate.
Right, that's right.
Today the interest rate could be 5%.
Absolutely.
6%. That's a different deal.
30-year mortgage at 6.3 or thereabout.
Right. All of that will start to come through the economy here at some point.
And I suspect the Fed will at least pause to reassess at some point. Of course, it's not in their favor to forecast that.
Right.
It makes no sense to do so, but hopefully by the time that they reconvene in November, the economic rollover is starting to happen. We're starting to see it in places. And
you said something I think is really important. The market is always 6 months ahead of where the economy is.
On average, 3 to 6 months. That's right.
So it's a great predictor of sort of where we're going.
Right.
We may not be there just quite yet
in
terms of the economy.
Right.
But the market is always ahead.
Right. Yeah. If you wait for the all clear as an investor to start either getting back into the market or increasing risk to your kind of target range, then it's too late.
It's too late. Exactly. So any other thoughts or any other?
I think on a go-forward basis, it's interesting. Vanguard came out with their expected returns on a forward 10-year basis in September. Really well respected firm, as many others that we have some level of relationship with. But I think it's just important to recognize the end result there, which is expected returns going forward for investors are going to be a lot lower, more than likely. I mean, they had large cap equities between a 4 to 6% band annually on a go-forward basis. I mean, that's a fraction of what we're used to over this easy money policy period of quantitative easing, really going back to 2009.
I was joking. I had my sleeves rolled up today, right? The reason why they're rolled up is because it's not easy returns anymore. You have to really work hard to go out and find really the right spots in your portfolio to find the most optimal use of your money. Mm-hmm. And that takes a lot of time, effort, and energy. It takes expertise. It takes a large team, which you and your team do a great job providing those expertise for us. So
thank you.
With that, I think that wraps it up for our September market update. As always, we thank you for the opportunity to be stewards of your wealth. And for John McArthur, I'm Ken Skornia. Thank you very much and have a great day.
Thank you.